All right, welcome to Iron Financial. We're the place you come to forge a stronger portfolio, especially when you need to cut right through the market's weakness. I'm your lead analyst, and today we're putting an absolute titan of industry under the microscope, Vulcan Materials. You know, ticker VMC. Now look, this isn't some flashy tech stock that lives on hype. This is a company that is quite literally the bedrock of the American economy. We're talking about the crushed stone, the sand, the gravel, the aggregates that build our roads, our bridges, our entire cities. It's supposed to be the definition of a solid, durable, unbreakable business. But after their latest earnings report dropped, the market didn't just get nervous. It reacted like it found a catastrophic fault line running straight through the company's core. The stock wasn't just down. It was taken out to the woodshed and absolutely hammered. Just look at this number, negative 8.29%. In a single trading day. Just let that sink in for a second. This isn't some volatile biotech stock that just failed a clinical trial. This is a foundational blue-chip industrial company, a name that big institutions own for stability, for safety. A drop this sharp, this violent, it signifies pure, unadulterated fear. The market didn't just dislike the report, it absolutely panicked. And over 8% haircut tells you that the big money, the so-called smart money, they didn't just sell their positions, they sprinted for the exits. They slammed the panic button. And the critical question we have to answer today is this: what in the world did they see that caused such a brutal, immediate reaction? Is this just a minor tremor, or is the entire structure about to give way?
You know, let me put that percentage into real dollars because a number on a screen can feel a little abstract. An 8.29% drop for a company the size of Vulcan meant that almost $4 billion, that's $3.91 billion with a B, in shareholder value was just obliterated. It just vanished into thin air over the course of a few hours. So the real question isn't just about a stock having a bad day. The real question is, did the market just send us a massive flashing red signal that the very foundation of this business, the thing that's supposed to be as reliable and boring as granite, has developed a deep structural crack? Is this a falling rock that we all need to get out of the way of, and fast?
That's exactly it. And that right there is the core tension we are going to rip apart in this explainer. Because you have to remember, inside every single market panic, there's always immense danger, but there can also be a once-in-a-generation opportunity. When you see the entire herd stampeding in one direction, it's our job here at Iron Financial to stand our ground, to tune out the noise, and to look at nothing but the cold, hard data. We have to figure out if the market is correctly pricing in a genuine fundamental business failure, or if it's just massively overreacting to some superficial damage. So is this a glaring red flag, a clear warning sign telling you to stay far, far away? Or is the market, in its panic, serving up a high-quality, durable business on a silver platter? Okay, let's get into it. First things first, we have to understand exactly what triggered this market earthquake. We're going straight to the epicenter, that fourth quarter earnings report. We are going to drill down into the specific numbers that sent a shockwave through Wall Street and caused this massive sell-off. Because if you want to understand the opportunity, you first have to understand the fear. You have to see precisely what the bears saw that made them run. All right, I'll take the lead on this one. Let's step into the role of the prosecutor here and lay out the bear case, piece by painful piece. Because from where I'm sitting, the market's reaction wasn't some kind of irrational panic. No, it was a perfectly logical, perfectly justified response to a company that fundamentally and on multiple levels failed to deliver on its promises. In my view, the punishment absolutely fit the crime. This wasn't just one weak metric we're talking about. It was a full-blown cascade of failures across the most important parts of the business. The numbers don't lie, and in Q4, they painted a very, very ugly picture. So let's start at the very top with Exhibit A, revenue. As you can see right here, Wall Street analysts, the folks who model this company day in and day out, they were looking for $1.94 billion in sales. Vulcan delivered $1.91 billion. Now, I know what some people are going to say, oh, that's only a 1.7% miss, what's the big deal? Well, in this sector, for this kind of company, it's a huge deal. For an industrial giant like Vulcan, revenue is the direct pulse of the economy. A miss here suggests that either construction projects are slowing down or their ability to command premium pricing for their product is getting weaker. It's the first sign that the entire demand story isn't nearly as strong as everyone believed. It's the very first crack in the narrative.
But look, if you thought that revenue miss was bad, that was just the appetizer. Now we get to the main course. Exhibit B, the bottom line, earnings per share. This, right here, is what I'm calling the profitability shock. The consensus on the street was for $2.11 a share. Vulcan came in at a paltry $1.70. I mean, look at the size of that miss. This is not a rounding error. This is a nearly 20% failure to convert their sales into actual profit for shareholders. For a company of this scale and this supposed stability, missing earnings by almost 20% is a 5-alarm fire. It screams that their costs, fuel, labor, you name it, are spiraling out of control, or that their pricing power is evaporating, or even worse, both. This isn't just a small crack anymore. This is a crater.
And for the final nail in the coffin of their quarterly performance, let's look at Exhibit C, adjusted EBITDA. For a lot of serious analysts, this is the most important number of all. It strips out all the accounting funkiness and gives you a raw, unfiltered look at the core operational horsepower of the business. The market was expecting over $600 million. Vulcan delivered just $518 million, a stunning 14% miss. What this number tells you is that the core engine of the company, the part that generates all the cash to pay down debt, to fund new quarries, to give back capital to shareholders, it's stalling out. It's running far less efficiently than anyone on the street anticipated, and that has incredibly serious implications for the future of this company.
And please, don't let anyone try to convince you this was just a one-off, oh, it was a bad quarter. Let's zoom out for a second. This chart right here shows the bigger and, frankly, more terrifying problem. Look at that bar on the left. For the last 5 years, Vulcan's been a growth machine, compounding its revenue at a really healthy 10.3% per year. Pretty good. But now look at the bar on the right. Over the last 2 years, that growth has slowed to an absolute crawl, just 1% annualized. That isn't a slowdown. That's hitting a solid brick wall at full speed. So the critical point is this. The disastrous Q4 miss wasn't some random anomaly. It was the ugly culmination of a dangerous trend that has been building for the last 24 months. The growth story is, for all intents and purposes, dead.
So let's just summarize the case for the prosecution. The market saw a trifecta of misses on the most critical metrics imaginable: revenue, earnings per share, and core profitability. It then looked at the bigger picture and saw a growth story that has decelerated from a full sprint to a dead standstill. The conclusion from the bear camp is simple and it is brutal. The punishment was not only justified, it was necessary. The market correctly identified a business showing clear, undeniable signs of deep structural weakness, and it repriced the stock accordingly. The foundation is cracked, and the bears were absolutely right to run for the hills.
A very, very compelling case from the prosecution, I'll give you that. And now, the defense gets its turn. You know, the market is a powerful mechanism, but it's also incredibly emotional. It's myopic. It often takes a single data point, in this case, one bad quarter, and it extrapolates it into a permanent disaster narrative. The bears are pointing out a few cracks in the drywall, but they are willfully ignoring the rebar-reinforced concrete foundation that lies just beneath the surface. It is time to zoom out beyond just 90 days of bad news and examine the full-year results, the balance sheet, and the actual cash-generating power of this industrial machine.
Let's start with the company's own words, pulled directly from the exact same earnings report that caused all this chaos. The headline actually read, "Full-year earnings growth and margin expansion." So while the market was obsessing over the weakness in the fourth quarter, management was desperately trying to direct everyone's attention to the bigger picture. A single quarter, especially a volatile final quarter of the year, does not define a business like this. So let's do what the panicking sellers clearly failed to do. Let's look past the noise of Q4 and analyze the actual performance for the entire year.
Let's talk about the one thing that really matters in a capital-intensive business: cash. Forget about accounting earnings for a moment. Cash is the lifeblood. And for the full year, Vulcan's operating cash flow surged by 29%. Let me just say that again because it's important. In a year where the market is now convinced the business is falling apart, it actually generated 29% more cold, hard cash from its core operations than it did the year before. This is not the sign of a struggling company. This is the sign of a powerful, efficient, cash-generating machine running at full throttle.
Okay, now let's turn to the bottom line. The audited net earnings for the full year. Over $1 billion. To be precise, $1.077 billion. Now that's a significant increase from the $912 million they earned in the prior year. This isn't some fuzzy, adjusted, made-up number. This is real, GAAP-audited profit growth. While the market was laser-focused on one disappointing quarter's EPS number, this company was quietly and methodically stacking up over $1 billion in annual profit. That right there is the very definition of a durable, profitable, and fundamentally sound enterprise.
Let's get even more granular. Let's look at the core business itself, selling rocks. How is it actually performing? This number is absolutely crucial.
aggregates cash gross profit per ton. It is the single best measure of their operational excellence. It tells you exactly how much cash profit they make on every single ton of material they pull out of the ground and sell, and that number increased to $11.33. This proves their pricing power is intact and their cost control is effective, despite all the inflationary pressures we hear about. They are becoming more profitable on their core product. This directly, and I mean directly, contradicts the bear case argument that their profitability is somehow collapsing.
Finally, let's inspect the foundation itself, the balance sheet. In a volatile market, a strong balance sheet is your ultimate defense. It's your fortress. Vulcan's total debt to adjusted EBITDA ratio is just 1.9 times. Now, in the world of heavy industrials, anything under 3 times is considered healthy. Under 2 times is considered a fortress. This tells us the company is not over-leveraged. It has immense financial flexibility. It can withstand market turbulence, continue to invest for the future, and weather any short-term softness in demand without even breaking a sweat. This is what real financial strength looks like.
So let's summarize the case for the defense. The market sold off in a blind panic, based on the results of a single 90-day period. But when you zoom out and look at the full-year picture, a completely different story emerges. You see a business with surging cash flow, growing net profits, expanding margins on its core product, and a balance sheet that is, truly, as solid as a rock. The crucial point here is that the market's short-term fear appears to be completely detached from the long-term, fundamental reality of this company's formidable financial health.
All right, so we've heard both sides of the argument. You've got the bear case, built entirely on that Q4 disaster, and you've got the bull case anchored in the full year's strength and that solid-as-a-rock balance sheet. But investing is always a forward-looking game. So the final, and maybe the most important piece of evidence we have to look at is management's own guidance for the year ahead. This is their blueprint for 2026. This is where we see if the weakness from Q4 is expected to bleed into the new year, or if the strength from the full year is the real underlying trend. This, folks, is the tiebreaker.
Whoa, hold on a second. I gotta jump in here. The tiebreaker? This slide looks like another clear win for the Bears, if you ask me. I mean, look at it. Their own guidance for adjusted EBITDA, that core profit engine we keep talking about, is centered at $2.5 billion. But Wall Street was expecting $2.65 billion. They are guiding below consensus. Management is explicitly telling the market that the year ahead is going to be weaker than the experts predicted. How is that anything other than a confirmation of the entire bear case? It seems pretty open and shut to me.
Okay, you're not wrong. I'll give you that. It is below consensus, and yeah, that absolutely threw gasoline on the fire on the day of the report, no doubt about it. But context is king here, right? You got to look closer. First off, what's the actual range they gave us? 2.4 to 2.6 billion. So think about it. Even the worst-case scenario in their guidance is still year-over-year earnings growth from the 2.3 billion they just reported. And second, come on, this is what experienced management teams do. They underpromise so they can overdeliver. It's setting a bar you know you can jump over. So yeah, it's a miss if you're just looking at some analyst's spreadsheet, but it is hardly a signal that the whole business is falling off a cliff. It's a signal of continued, albeit maybe moderated, strength.
Okay, all the evidence is now on the table. We've heard the prosecution's case, built on a disastrous fourth quarter and what looks like disappointing guidance. We've heard the defense's case, built on a powerful full-year performance and a rock-solid balance sheet. We've examined the forward-looking blueprint. It is now time for us here at Iron Financial to weigh the conflicting arguments, to cut through all that emotional noise of the market, and to deliver our final, actionable verdict.
Let's just put it all on one screen. This is the entire conflict in a nutshell. On the left, you have the bear case. It's all about the short-term pain. That ugly trio of Q4 misses, that really scary growth deceleration chart, and the guidance that came in below what Wall Street wanted. It's an emotional argument, and it's based entirely on recent events and forward-looking fear.
And on the right, you have the bull case. And that's all about the long-term structural integrity of the business, the incredible full-year cash flow generation, the expanding unit profitability, and that fortress balance sheet we talked about. It's a colder, more rational argument based on fundamental, year-long strength. The entire debate really just boils down to which of these two stories you believe is the more reliable signal for the future.
Our verdict at Iron Financial is decisive. The market overreacted. The fear and the panic that was generated by one bad quarter have created a significant dislocation between the stock price and the underlying intrinsic value of this business. The evidence of fundamental strength, the surging cash flow, the full-year profitability, the fortress balance sheet, the improving unit economics, it is simply too overwhelming to ignore. The market sold the narrative of a collapse, but the facts point to a highly durable business that just went on sale. The foundation is not cracked, it is made of steel. In our view, the market has just handed long-term investors a gift.
So, the final question isn't for us, it's for you. The analysis is done, our verdict is in, and now it all comes down to execution and investor psychology. Do you have the discipline that it takes to be a buyer when the headlines are negative and everyone else is selling? Can you look at a sea of red on your screen and see opportunity instead of just risk? Or are you going to let the market's short-term fear demolish what our analysis shows is a truly solid long-term opportunity? The choice, as always, is yours. Thanks for joining us at The Explainer from Iron Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.